Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're looking at if investors should consider buying beaten down Lululemon stock before it reports its earnings later this week. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. All right, so Lululemon was a standout in the market over the last several years, and it helped change the way people dress, but the stock has fallen behind recently. So we're going to take a deeper look at the athleisure firm before it reports its first quarter fiscal 2021 financial results after the market closes on Thursday, June 3rd. But before we get into everything, it's worth recapping the broader earnings picture and some key market factors just to help investors better understand Lululemon's position in all of this. So the past several weeks have been dominated by inflation fears that ramped up following April's big 4.2% jump in the consumer price index. So that was the largest 12-month climb since 2008. It came on the back of ramped up spending, government checks, supply chain setbacks, and comparisons against those coronavirus lows. Wall Street has, however, seen buyers step in anytime they felt things were a bit overdone. So the S&P 500 has found its support above its 50-day moving average this whole time, and the NASDAQ, which already suffered a correction in 2021, which marks a downturn 10% from its highs, has regained its footing after its pullback. So the tech-heavy index is once again trading above its 50-day moving average, and the benchmark index has already pushed back within touching distance of its record. So the market is the bulls are dominating the market once again, despite these inflation fears. So there appear to be multiple reasons behind the bullishness amid the inflation worries. So the overall earnings picture for Q1 was impressive, and the estimates for second quarter keep going up. So as of early January, our Zacks estimates for Q2 earnings for the S&P 500 were for about 42% top line growth, or 42% earnings growth. And as of last week, that figure was already up to 59%. So we went from 42% earnings growth for Q2 all the way up to 59% growth, just based on all the positive guidance from companies that have already reported their first quarter results. So that big positivity on the Q2 front. Overall, we're expecting 34% top line growth this year. We're expecting 34% earnings growth this year and 10% top line growth, and then 12% earnings growth next year and another 6.5%. So this positivity obviously is helping justify that comeback. And then also we have the fact that the US GDP is supposed to grow by about 6.5% or more in 2021, which would be the strongest in roughly 35 years. So along with that booming U.S. economy that's been driven by the vaccine rollout, some Wall Street bulls might be focused on the likelihood that there is no alternative investing continues, even if the central bank is forced to raise rates sooner than originally expected, trying to tamp down prices, because the yield on the 10-year Treasury, which is sitting at about 1.61% at the moment, which is about where it was right before the pandemic, has held at around these levels for the last 3 months or so. And obviously, this is still low compared to historical standards. In fact, the 10-year yield has only gone above 3% a few times in the past decade. So even if we do see higher rates that make, say, growth tech stocks a little bit less attractive, it seems a little unlikely that investors are simply going to want to park their money in relatively low yield bonds, even if rates rise. Given that the annualized return for the S&P 500 is around 11% since the late 80s. So parking your money in, even if interest rates keep climbing to, say, even all the way up to 3% or something like that, it's doubtful that it's going to be a huge reversal of stock market investing as people are trying to chase those returns. So with this all in mind, as Wall Street is pushing stocks back to their records, we're going to turn to a stock that has not been able to find its footing so far in 2021, which is Lululemon, which trades under the ticker LULU. The stock was on a huge run over the last 5 years, and it's still up about 375% to blow away the apparel market. It's 100% climb. Nike's 160% jump, and the benchmark index 130% climb. So the athleisure standout that turned into pretty much a sportswear powerhouse, was soaring in 2020 as well. Off those coronavirus lows, as Wall Street praised its ability to grow its e-commerce business amid that stay-at-home economy. Lululemon shares have, however, fallen around 15% since early September, as investors have been underwhelmed by its guidance and just took a step back from the somewhat overheated stock as well. So despite the pullback, the company's growth outlook and its fundamentals remain relatively strong, which means investors might want to consider the beaten down stock heading into its Q1 release on Thursday. So now we're going to just jump into more of a breakdown of the company. So Lululemon has expanded from a niche, high-end, yoga-focused clothing firm in the late 1990s to a global apparel giant at the moment. Today, the company sells an array of athletic apparel for both women and men, alongside clothing that can be worn more to work, on dates, the golf course, and beyond. So Lululemon's successful athleisure business has also slowly sort of helped change the way people are dressing. Even as people will start returning to their office, it's unlikely that people are going to start wearing suits again anytime soon, besides a select few, people, not as many, obviously not as many people wear a suit anymore, and just more and more workplaces, even very high level businesses, are having a much more relaxed environment. And not that people are wearing yoga pants to work, but Lululemon is selling things that you could definitely blend in at work with polos and more comfortable pants. So the Canadian company's focus has forced everyone from the Gap to Target to start their own athleisure brands. And it's also pushed into outerwear, challenging the likes of the North Face and other companies like Patagonia. Lululemon has also rolled out self-care products, and last June it announced its purchase of the digital-focused at-home fitness company, which is Mirror. I'm sure maybe some of you have seen those ads. The acquisition helps it expand into a hot growth category alongside Peloton and other companies. The home fitness market's so hot that it's also attracted the likes of giants such as Apple. So that could be a key for Lululemon going forward as well. So Lululemon has always been focused on its direct-to-consumer business as well through its own standalone stores and e-commerce. And this model certainly paid off over the last year and will continue to be beneficial as many department stores struggle to adapt to the changing shopping habits that were already well in place before the coronavirus. So the company closed Q4 with about 520 stores total, up from about 490 the year before. So even during the pandemic, they were opening more stores. Lululemon executives are also focused on growing in Asia and outside of that key North American market as well. So it's introduced experiential stores as well that include yoga studios and cafes. One of them is in Chicago that I've actually been to. So if that continues to be successful, maybe you see more of those in the future. So all of these efforts have helped Lululemon's annual revenue grow by an average of about 17% in the past 5 years. This includes 11% expansion in the COVID hit 2020 that saw its first quarter sales actually fall 17% amid those early quote unquote non-essential business shutdowns that now seems like a lifetime ago. But despite that, it had a big bounce back in the second half of the year, so it closed out the year with 22% sales growth in Q3 and 24% growth in Q4. Its growth was driven by a huge jump in e-commerce. So in fact, e-commerce revenue accounted for about 52% of total Q4 revenue versus just 33% in the year ago period, with its direct-to-consumer revenue up 94% in the fourth quarter. So overall, the growth continues to come from all over the place as well. So its men's revenue was up 17%. Its women's revenue was up 19%. It reportedly gained 1 point of U.S. retail market share during the fiscal year, and it continues to just grow as well. So all over the place. Its international revenue was up 47% as it expands more places outside of North America and Australia, with its North American revenue up 21% as well. So looking ahead, given that backdrop, we're calling for a whopping 71% sales growth against the easy to compare period last year, and a whopping 310% adjusted earnings growth for its coming Q1 results. Overall, we're expecting the company's fiscal 2021 revenue to jump by 29% all the way up to $5.7 billion. So a big top line jump. And then that's expected to help lift its adjusted earnings by about 38%. So 29% on the top line, 38% on the bottom line. And then we're expected to see it follow up this year's growth with another 17% earnings or sales growth in 2022 to jump all the way up to $6.6 billion. So adding an additional $1 billion in sales expected in 2022 with another 24% growth on the bottom line. So big growth expected both this year and next year. And with that 29% top line growth expected this year and 17% expected next year, that would stack up really well compared to what it's done over the last several periods. So before the coronavirus, its 2019 revenue jumped 21% and its revenue jumped 24% the year before that. So this growth would stack up very well compared to that. With that in mind, its earnings estimates, so its consensus earnings estimates, have trended a little bit in the wrong direction recently, which is not the best sign heading into earnings results. So these slight downward estimates have pushed it to a Zacks rank number 4 sell at the moment. But this is a fluid ranking that could certainly change in the lead up to its earnings release on Thursday, and especially after the release if management is able to provide strong guidance for Q2 and the rest of the year going forward. So with this in mind, so far in 2021, Lululemon stock is down about 8%. This compares to Nike's 4% decline and the overall apparel market's 2.5% jump. And then just as a point that's worth noting, Levi, so Levi makes jeans, their stock's up about 40% so far in 2021. And this is that shift that a lot of people have seen as people are assuming that since people have been cooped up for so long, they're going to start wearing jeans and maybe shun the athleisure stock. So that's why Lululemon's trading about 17% below its September 2020 highs. Its RSI is sitting at around 49 at the moment, which is right under that neutral level. And the stock was down about 1% as of the last time I looked on Tuesday morning. It's trading at around $320 a share. So once again, that's about 17% below those records. Then it's been pretty stagnant over the last several months, and it's down overall 8% so far this year. So given this, there is certainly room for a post-earnings jump if they're able to impress, given that the stock has been so subdued recently, especially when the market is once again back near those highs. Lululemon also lands A grades for growth and momentum in our style score system, and 14 of the 22 brokerage recommendations that Zacks has are strong buys, with none below a hold. So overall, Wall Street has remained positive, even though the stock has slowed down over the last 6 months or so. And the stock is also, it's still a value in the sense that it's trading 20% below where it was. Its valuation is not stretched at the moment, even though it's still trading in the sense that it's a growth stock. It's trading at about 46 times forward 12-month earnings, which might be a little rich for some people's blood, especially since it's an apparel stock. So this is trading above the industry's 26.9 times average. But clearly, Wall Street's been willing to pay up for Lululemon for a long time. And with these growth projections that the stock has, it might be willing to do that for much longer as well. So long-term investors might want to consider Lululemon trading about 17% below its highs heading into that Q1 release on Thursday, but it also might be best if you're to just take some time and see how Wall Street reacts to its results, and it's better yet, its guidance, especially with all the unknowns in terms of what the reopening has done to consumer habits amid all of this pent-up demand. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.